I want you to picture a scenario, and it's a scenario that I think haunts every successful business owner.
Mm-hmm.
You have spent your entire adult life building something. We're talking 40 years. The late nights, the missed family events, all that stress that wakes you up at 3 in the morning.
It's more than a job.
Yeah,
It becomes part of you.
exactly. And you succeed. You actually build this empire. You've got the properties, the plant, the whole setup. A massive success. And then the clock runs out. You pass away.
And that's the moment of truth for the legacy. Does it survive the founder?
That is the question. Because here's the nightmare version. Your family, they're grieving. And the executor of your estate sits them down and drops this bombshell. The tax bill, specifically estate duty, is so massive there's just not enough cash in the bank to pay it.
It's the classic asset-rich, cash-poor paradox.
Yeah.
And it is devastating.
And the results. To pay the tax man, your family has to start selling off the very assets you spent a lifetime building.
The building goes, the shares get liquidated.
The empire just collapses to settle the bill. It's the ultimate nightmare.
And it happens all the time. For most successful entrepreneurs in South Africa who don't plan, this is pretty much the default setting.
Well, today, we're going to make sure that is not the default setting for you. We are doing a deep dive into the concept of the fortress.
I love that name.
It's perfect, right? We're looking at how to structure your wealth so it's protected from that massive tax bite, but also from things like lawsuits, creditors, all those risks.
And we've got some fantastic source material for this. We're breaking down a really comprehensive guide on something called the Usufruct strategy, which is this fascinating legal tool from Roman times?
All the way back to Roman times, yes. And we're pairing that with the modern methodologies of trust consultant Lumka Sturman and her fortress model.
So our mission today is pretty straightforward.
I think so. We want to explain how you can take this ancient legal concept, combine it with a modern trust, and literally save your family millions.
And we mean literally millions.
In taxes, while also making your assets basically bulletproof. It's about shifting your mindset, from just making money to actually protecting it.
So let's start with the threat. We need to understand the enemy here.
Mm-hmm.
What exactly is this tax trap?
What are we up against?
Well, the enemy is liquidity, or I should say the lack of it. So in South Africa, estate duty is levied at 20% on the first R30 million of your dutiable estate.
20%.
And anything above that, anything over R30 million, gets taxed at 25%.
Now, R30 million might sound like a huge number, but if you own a successful business, the land it's on, maybe a holiday home, you can hit that number a lot faster than you think.
Oh, surprisingly fast. And this is where the trap snaps shut. SARS demands that tax in cash.
Right. They don't want a piece of the factory.
No, they want rands. But a business owner's wealth isn't usually in cash. It's in the building, the machinery, the stock. It's all reinvested.
Because that's what good entrepreneurs do. They put the money back into growing the business.
Exactly. So when SARS demands, say, 20% of the value of that factory, you can't just slice off a corner of the building and hand it over. You're forced to sell the whole thing just to find the cash.
The sources gave a really painful example of this, the case of Richard and Margaret Thompson.
Oh, that one is tragic because it was so preventable.
Let's walk through it.
Okay, so Richard, he built a manufacturing business over 35 years. Solid guy, worked hard. When he passed away, his estate looked great on paper. The business was worth R45 million. He had a commercial property worth R18 million, his home. The total gross estate was R87 million.
87 million. That is a phenomenal success story.
It's the dream. Until the bill arrived. After all the deductions, the estate duty liability came to nearly R17 million.
17 million, right?
17 million.
Wow.
And it gets worse. The family didn't have R17 million in cash just sitting there. Why would they? Richard had plowed everything back into the business. So to pay SARS, they were forced to sell that commercial property.
And I'm guessing that property was generating income for his wife, for Margaret.
Of course it was. It was her pension. It was the income stream she was meant to live on. By selling the asset to pay the tax, they killed the income. The business survived, but the family's financial security was gutted.
That's infuriating because he thought he was doing the right thing. Okay, so that's the terror. Let's talk about the solution. The sources introduced this word, usufruct.
Yes.
It sounds like an exotic fruit or something.
It does, doesn't it? It actually comes from Roman law, and it basically just splits property ownership into two separate bundles of rights. It says owning something isn't just one thing.
Okay, break down the two bundles for us.
So first you have the usufructuary. And this is the right to use the property and enjoy its fruits.
The fruits.
Yeah, so in Roman times, that meant literally eating the apples from the orchard. Today, it means collecting the rental income from a building or living in the house rent-free.
Okay, so that's bundle one, use and income. What's bundle two?
Bundle 2 is the bare dominium, which is a great name. It's the ownership of the property itself, but without the right to use it yet.
So it's like, my name is on the car's title deed, but you have the only set of keys.
That is a perfect analogy. You, the bare dominium holder, own the shell. I, the usufructuary, get to drive it around and enjoy it.
Okay, so why do this? It seems really complicated.
It does, but this is the magic trick. It's all about what happens when you die.
Yeah.
If you hold a usufruct, you have the right to that income for your lifetime. But when you pass away, the usufruct just evaporates.
Yeah.
It ceases to exist.
It's not in your estate to be passed on.
Exactly. It's gone. The full ownership just automatically consolidates with whoever holds the bare dominium. So only the value of the usufruct is in your estate, not the full capital value of the property.
And how is that value calculated?
This is the clever part. It's based on your life expectancy.
Ah, so the older I am, the less my right to use it is worth.
Precisely. If you're 95 years old, the right to live in a house for the rest of your life isn't worth that much, statistically speaking. SARS has tables for this. So for a 65-year-old male, the usufruct is valued at about 56% of the property's value.
Okay.
But for an 80-year-old, because his life expectancy is shorter, that value drops to around 28%.
So you're telling me if I'm 80 and I only hold the usufruct on my building, I'm only taxed on 28% of its value when I die?
Roughly, yes. The other 72%, the bare dominium, was moved out of your estate years ago. Let's look at the William Harrison example from the sources to make this real.
Right, William. He's 68. He owns a commercial property worth $25 million, and it pays him $180,000 a month in rent.
If he does nothing, that $25 million is in his estate. Massive tax bill. Instead, he transfers the bare dominium to his children, but keeps the usufruct for himself.
Wow. Does his life change at all? Does he lose that income?
Not one bit. Not a single cent. He still gets the $180,000 every month because he's the usufructuary. He's still in control. But legally, the ownership shell has moved. When he eventually dies, the value in his estate is massively lower, saving his family over $3 million in estate duty.
That's incredible. He basically gives the building away but keeps all the income, and the tax man can't touch the capital value. But wait, hang on.
Go on.
If he's just giving the bare dominium to his kids, isn't that a donation?
You are spotting the pitfalls.
I mean, donations tax is a flat 20%. If I give away an asset that's worth millions, I'm going to get hit with a huge tax bill right now. That kind of defeats the purpose.
You're absolutely right.
Yeah.
And that's why we don't donate. We sell. This is the advanced part. The sale with usufruct strategy.
Okay, walk me through that, because the kids probably don't have millions sitting around to buy the shell of a building.
They almost never do. And usually, we sell it to a trust. Not the kids directly, for even more protection. But the mechanics are the same. You, the owner, sell the bare dominium to the trust. The trust doesn't have cash, so you lend the trust the money to buy it from you.
Ah, so it's a loan. It's a paper transaction.
Largely, yes. On day one, the trust owns the bare dominium, and the trust owes you a massive debt. You still hold a usufruct, so you keep getting the rent.
And what happens to that debt?
It can be paid back over time. But here is the most critical part. Any future growth in the value of that property happens inside the trust.
I see. So if the property doubles in value over the next 10 years, that growth isn't in my estate.
Not at all. You've frozen the value in your personal estate at the day of the sale. All that appreciation now belongs to the trust, completely protected.
There's a specific example in the notes, the Robert Anderson one, that I think every business owner who owns their premises needs to hear.
Yes, the business premises strategy. This is brilliant. So Robert owns his factory. It's worth $30 million. His company rents it from him. He sells the bare dominium of that factory to a trust.
Does his company stop paying rent? Does his income drop?
No, not at all. The company still pays rent to Robert because he holds the usufruct. His income is unchanged. But he has immediately shifted $13.5 million of value out of his estate. And if that factory is worth $45 million when he dies, all that extra growth is safe in the trust. He saves something like $8 million in taxes just by shuffling paperwork.
That is the definition of working smarter. But we've been focused on tax. I want to pivot now to the other side of this. Risk. It's not just the tax man coming for your money.
No. It's creditors, lawsuits, life. This is where we bring in the philosophy of Lemke Sturman. Her whole approach is what she calls the asset protection fortress.
I just love that imagery, a fortress.
It's perfect. Lunke points out this huge problem. Most entrepreneurs have everything in their own name. Or, and this is a big one, their trading company also holds the valuable assets, like the building.
Right, so if the trading company gets sued or goes under, the building is on the line.
Everything is on the line.
Yeah.
Or the owner signs personal surety for a business loan. Lumke's point is, one lawsuit or one SARS audit can threaten everything you've built.
So how does the fortress model fix that?
It creates a separation. You have the safe, and you have the operator. The trust is the safe. It owns the assets, the property, the cash, the investments. Then you have your company, which is the operator. The company takes all the risks. It trades, it hires people, it signs contracts.
And if the company goes bust,
The creditors can attack the company, but they can't get past the walls of the fortress. The trust's assets are legally separate. You still control them, but you don't own them personally.
you control everything but own nothing. That's the mantra, isn't it?
That's the one. And this is why trusts are such a positive thing for business in South Africa. It's not about hiding money. It's about continuity. It's about resilience. If a founder messes up in the trading company, the family's core wealth shouldn't be wiped out.
That's a crucial distinction. Now, looking at the material in Limke Sturman, she seems very focused on being an educator. She wrote a book, Shield Your Business Empire. She does workshops. She talks about the learner persona.
Yes, she really wants you to understand the why behind it all, which is so important because, let's be honest, this stuff sounds really complicated.
It does. Which leads me to the question I know people are asking. Can I just do this myself? Download a template and get it done?
Please, please do not do that. I have to put up a giant warning sign here. This is absolutely not a DIY project.
Why not? If the concept is simple, why can't I just draft it up?
Because the tax laws are just littered with landmines designed to catch you out. Remember that loan we talked about,
Yeah.
where you lend the trust money to buy the bare dominium?
Yes.
There's a section in the Tax Act called Section 7C, and it is nasty. It was designed specifically to stop people from using interest-free loans to trusts. If you make a loan like that, SARS says the interest you should have charged is a donation, and they tax you on it every year.
So I could end up with a huge tax bill on money I never even received.
You could wipe out your cash flow just trying to save on estate duty.
Huh.
You need a professional to structure that loan properly. A template won't do that.
Okay, so Section 7C is one landmine. What else?
Capital gains tax. And transfer duty. When you move that bare dominium to the trust, that is a disposal in the eyes of the law. You have to pay CGT and transfer duty now.
So I have to pay money today to save money later.
Yes, and you need someone to actually run the numbers. Is it worth paying, say, our $500,000 now to save our $5 million later? Usually, yes. But you have to calculate that break-even point. If you do it too late in life, you could just cost yourself money.
And I saw a note about maintenance. That seems like a tiny detail.
It's not a detail to the law. As the usufructuary, the person getting the benefit, you are legally obligated to maintain the property. If you let the roof on the factory collapse, the trust can sue you. Or worse, SARS can look at the whole thing and say, this is a sham, you're not treating this like a real legal arrangement, and they can tear the whole structure down.
So you can't just set it and forget it. You need checkups.
Exactly. This is where Lumke Sturman Services come in. She does these fortress checkups and exposure risk analysis. It's about maintenance. You don't build a fortress and just walk away. You have to man the walls.
I see she actually has a wait list for her asset protection fortress setup.
It's a very involved process. It's not just a document. It's about planning, compliance, a whole ecosystem. But for people who are just starting out, she has something called a foundation audit.
That sounds like a great first step. Just see where the cracks are before you build the skyscraper.
That's it. The main takeaway is that the complexity shouldn't stop you, but it should be the reason you get proper help. The upside is just too big.
And there's a cost to waiting, a cost of inaction.
A huge one. Every year you wait, two things happen. First, you get older.
Thanks for the reminder.
Well, it's true. And as you get older, your life expectancy drops, which means the value of the usufruct drops. So the bare dominium is worth more, which means you pay more transfer duty to move it.
So doing this when you're younger is actually cheaper.
Much cheaper to set up. And the second thing is the property value is going up. Every year you wait, that building is worth more. And that's more value that's stuck in your estate, accumulating a future tax liability.
The best time was 10 years ago. The second best time is today.
That's the line.
Okay, so let's bring this all together. What have we built for our listeners today?
We started with the tax trap, how estate duty can gut a family business. Then we introduced the usufruct as a tool to split ownership and massively reduce that estate value.
We talked about the sale with Usufruct to get around donations tax and how business owners can use it for their own premises to freeze the value growth outside of their personal estate.
And then we zoomed out to the asset protection fortress with Lumka Sturman, using trusts not just for tax, but for stability and risk management. And finally, a big warning about doing it right.
So if this deep dive has sparked something for you, if you're thinking, I need to build my fortress, then you should probably look into this.
Definitely. You can find all of Lumka Sturman's resources on her website. It's www.lumkasterman.com. You can join the wait list, get her book, or just book that foundation audit to see where you stand.
It seems like she really guides you through the process, which is what you want.
You need a partner in this, not just someone who files forms.
Right. I want to leave everyone with one final thought. We always think of business success in terms of revenue and profit, but true success is longevity. It's about what happens when you're not there to steer the ship.
There was a line in the source material that summed it up perfectly. It said, your business protects your income, but a trust protects your wealth.
Don't leave your legacy to chance. Thanks for listening to The Deep Dive. We'll see you next time.
Goodbye.